The American economy has officially encountered the two most feared monsters in financial history at the same time: inflation that won't quit and growth that has disappeared. Today, March 23, 2026, the S&P 500 has erased 6 months of gains in just 4 weeks, marking the longest losing streak in 3 years. While the White House declares a strategic pause, the markets are pricing in a stagflationary shock that is rapidly liquidating household wealth. We are looking at a default on prosperity, where the cost of energy has become a permanent tax on the American worker. The Federal Reserve has officially hit the emergency brake. After months of promising rate cuts, Fed officials have admitted they are now pricing in the possibility of rate hikes before year-end. From an accounting perspective, this is a liquidity trap. Usually when the economy cools and unemployment goes up, the Fed cuts rates. When it overheats and inflation goes up, they hike rates. But today, they face both. Brent crude is trading above $113 per barrel, and inflation is projected at 2.7% for 2026, yet the labor market is starting to contract. The Fed is bankrupt of options. Hiking rates to fight oil-driven inflation will only accelerate the recession. I'm Camilo Motato, reporting for Thu News. As a certified public accountant, I track material inconsistencies. In a standard audit, when the management discussion says they don't know if the effects will be much smaller or much bigger, it is a signal of internal control failure. Today we are auditing a stagflationary moment that mirrors the 1970s, where the input costs of energy are feeding through every single sector, from the $3.94 gallon of gas to the 6.53% mortgage rate that is freezing the real estate market. The operational risk of this war is now quantifiable. The closure of the Strait of Hormuz has removed 20 million barrels per day, roughly 20% of global consumption, from the ledger. As a professional, I audit systemic shocks. The 1970s Arab oil embargo only removed 7% of consumption. Today's blockage is nearly 3 times as severe. While Asian markets like Japan and South Korea are in freefall because they get 75% of their oil from the Gulf, the US is discovering that its energy independence was a paper asset. The global price of oil determines the cost of American goods. And with Iraq declaring force majeure and refineries under drone attack, the supply chain for affordable life in America has been severed. In forensic accounting, we look for historical precedents. What we are seeing from the Trump administration, specifically through the Genius Act and figures like Scott Bessent, is an attempt to emulate the 1971 Nixon Shock. Back then, Nixon devalued the dollar by 30% to make the rest of the world pay for the American deficit. Today, the playbook is similar, privatizing the dollar through stablecoins and using high energy costs to devalue the currency by 20% to 30%. This isn't an accident, it's a management reorganization of the dollar. As a CPA, I view this as a high-stakes debt restructuring, where the goal is to suck global capital into American big tech and AI, even as the working class pays the inflationary tax at the pump. While the US is trapped in this stagflationary cycle, Europe and Canada are positioning themselves for a relative win. By integrating their defense procurement through the SAFE initiative and relying on Norwegian pipeline gas rather than the volatile Strait of Hormuz, they have built a risk buffer. From a forensic perspective, investors are looking for safe haven assets outside of the dollar. Because the Fed is paralyzed, unable to cut rates due to $113 oil, but unable to hike without killing growth, capital is migrating toward blocks with diversified reserve portfolios. Canada and Europe are essentially receiving a diversification dividend as the US vacuum cleaner for global capital starts to lose its suction power. The most technical audit finding is the spike in the 10-year Treasury yield, which jumped to 4.38% from 3.97% before the war. As a professional, I audit yield inversions. When bond yields spike, they pull capital away from the stock market and push mortgage rates to 6.53%. This is a liquidity drain on the American middle class. We are witnessing the first empire in history that managed to stay hegemonic by going deeper into the red, but that model requires the world to keep buying US debt. If the Genius Act fails to keep the dollar as the world's primary vacuum cleaner, the systemic insolvency of the US deficit becomes the market's primary concern. The final audit of March 23, 2026, shows that the energy trap set by regional conflicts has finally triggered a stagflationary margin call. As a CPA, my verdict is that we are witnessing a strategic default on the stability of the 20th century economic order. The Fed's plot is no longer a guide, it's a list of bad options. The vacuum cleaner is clogged with high energy costs, and the Nixon Shock 2.0 is creating a world where the dollar is a problem for everyone else, just as much as it is for us. But I want to hear from you. Is the Nixon 2.0 strategy a brilliant way to save American hegemony, or is it a tactical suicide that will leave the US isolated? Can the Fed survive a stagflationary shock without a total market liquidation? Let me know in the comments. Your perspective is the only audit that matters when the global ledger is being redrawn. I'm Camilo Motato, certified public accountant for Thu News. Subscribe to stay informed on the truth behind the headlines. Stay safe.